Welcome back. In today's video, we're going to talk a little bit about raising and structuring deals using private finance. Get things kicked off, we've got this main point, which is in any property deal, you need to find the deal and then you got to fund the deal, right? And both are as important as each other, right? So we're just going to concentrate on the funding the deal side. And when you're funding a deal using private finance, irrelevant of senior debt, etc., which I'll make another video on, private finance is usually two different ways. Either you use a loan or either you joint venture with the person, JV. Right, with the loan, you're going to be raising debt and you'll be indebted to this person. With the JV, that you're going to be giving them equity in the deal. Alright, let's talk about each of these in a bit more detail. So if you're getting a loan of someone, then you're in debt to them. You're either going to be, depending on the percentage you give, it might vary from 6 to 15% return on whatever the capital they invest. This is fixed, meaning it's a fixed amount for a fixed time for a fixed interest. So you can't really change, or something goes wrong in your project or something takes longer, you can't really play around here. You need to pay the debt back when it was due, as it was due, the amount that is due. On the other side, you got a joint venture where you're giving equity. They're going to be essentially a business partner in this deal. So you also, when you're picking a joint venture partner, you need to be spending a lot more time here because they're going to have a lot of input into the deal. This is different, however. So say you make a lot more profit in the deal, then the joint venture partner makes a lot more profit. It depends on what percentage they're taking, usually 50-50, which obviously if it was debt, it would be different. You only have to pay out a certain amount. With the joint venture, you have to pay half of whatever you make. However, if there is a loss, they share that loss. They're sharing the risk as well as the reward here. That's the key differentiator here, that they're sharing whatever risk and whatever reward, which can work in both ways. If you're quite certain with what you're doing, you might want to go for the debt side because the more money you make, the more profit you get to keep for yourself. With the joint venture stuff, the FCA's got some regulations on it, not just for property and business in general. So a lot of people usually try to go for the debt side, and usually a busy investor doesn't want to have a lot of input joint venture with you. They just want to, this is what I'm giving you, I want this much back at the end of the year, happy days. Talk a little bit about structuring the deal, right? There's various ways to structure it. A lot of people tend to use a private investor. If you have no funds yourself, use private investor finance for the deposit and use senior debt from a lender, a bank, to cover the rest of it. So for example, if you need to put 50% down of the purchase price for a development, you might raise that through private investor finance, and then the the other 50% of the purchase and 100% of the development will be covered by the lender. But this obviously depends. So that's one way. Another way is having various private investors cover the project. So if you're going to cover the entire purchase and build of a project using private investor finance, you might do it in various ways. Where someone covers the main bit of purchasing the property, someone else covers the development side, and this will vary. I don't want to get into too much depth at the moment or too much detail here, but someone that covers the project for the length of it, which is probably the purchase of the property, you would give something like we might offer something like 6 to 12% in general throughout the project. So this person might get 6 to 8%. Someone that just coming in for the build might get 12% because it's a short period, higher risk. They might take second charge, whereas the person covering the entire project may take first charge. And if anything goes wrong, then that investor gets to keep that project. So there's various different returns depending on where you get involved in a project. Even we give returns on projects of 10+%. So if you are interested, obviously do get in touch over on our Instagram. But that's pretty much how you structure a debt-based deal. And managing people's money is key. If you want to be in a business and you want to last in a business, especially when you're dealing with other people, private investors finance, your name means everything in a business. So if you do well with one investor, they're going to refer you another person and another person. That's how real trust is built within investors, I think it's the easiest way. So you know, when you're using other people's money and you're managing it, you need to make sure you know you've done your numbers correctly, because if anything does go wrong, then that could be the end, be all and end all of your business. So, you know, make sure the project has enough profit, you know, make sure you're taking on the money at the right times, you've got all these contingencies in place, you know, be very careful. So that's how we do it. You know, we want to be safe, we want to be, even if we're going to lose money, we want to make sure that the investors pay. So even if we lose a bit of money here, they're covered in the next project, you know. I mean, they'll come in and want their same returns on the next project, and that's what it's all about. You know, if an investor invests you and they're happy with what what you're delivering to them, they'll keep investing with you year on year, because they want to get returns, right? That money's not going to be going back into their bank account and just sitting there. So that's very important, right? Now we want to talk a little bit about joint venture. Joint venture is very different, right? So if we decide to go on a joint venture, usually is because, say, we're leveraging our time, knowledge, experience, and the investor wants to be kind of more involved in the project, but has, you know, cash sitting there, and he wants to, you know, have an equity. You know, it depends on the risk adversity that the investor chooses to have. Usually, if you're going for the debt side, you know, you just want his fixed return. But the joint venture side, they don't mind, you know, making a bit more money, having the chance to make more money, and also, you know, take on a bit of risk with it. That's very important. You know, it's all about just building those relationships, and I think it's key. It's harder to start off with, to build that relationship with investors, especially if you're just starting off. But you know, once you do build it, you know, they're just going to keep coming. You know, people ask me, where do the investors get their money? And usually they're just an average professional, you know, who's, you know, very time poor but cash rich, and wants to get their money working for them because they've realized that it's better than leaving it in the bank account, right? So that's how we usually go around. You know, a lot of people don't realize that you can use your SAS to invest, savings. You know, maybe you come into inheritance. There could be a variety of different reasons, you know, and they just happen to come into a bit of money and they just want to reinvest it. So that's usually where, you know, investors have their funds, where to find the money, where to find investors, right? And I think one thing that a lot of people don't realize is that people around you're always trying to go out and find investors. You know, networking events is also a good place to meet investors, but it's a lot harder to build that relationship when you have a circle around you, say from family, you know, extended family to friends that see your work ethic, see what you're doing. They're more likely to invest in you first, right? So start there. Then again, networking is good. Obviously during Corona it's quite hard to get out there, and I think a lot, and I've seen a lot of success here is through social media. You know what, your social media platform should be something almost like a portfolio, you know, where you're showing off the work you've done. And by this, people that follow you and they see the work you're doing, they see the progress you're making, the results that you're producing, and then they're like, okay, this guy knows what he's doing, let's push some money through him, make a return for ourselves. You know, you need to utilize all these channels. I think getting on social media and, you know, being active is harder than said, but once you get a routine onto it and you start posting stuff and you start showing your work, it gets a lot easier. So I think that's key. You know what it is, there's no magic genie to, you know, just pop investors out of nowhere for you. You need to be putting in the work from day one. You know, people usually find a deal and then they're like, shit, look, we need to find one now. But, you know, that's too late. You need to be like, if you're posting consistently or talking to people consistently, let them know what you're doing. And once the deal comes up, you can pop the question, like, because you've already made that relationship, you've already made them acquaintance. You can't just pop up and be like, okay, we need to complete on this project in 28 days and I need 200k. That's really not gonna work. So I think you gotta pre-plan this stuff, and there is no easy answer. You just gotta put work in, build relationships, build rapport with people all around you, tell everyone what you do, tell everyone what you offer, and over time people will build that trust with you, and if they follow you and they see your work, things will start happening. That's pretty much it, guys. I hope you enjoyed it. It's a quick video on raising private finance, how to structure stuff. If you have any questions, if you want any advice, ask me in the comments below. I'm always active in there and I always reply to you guys. You know what, it's about a community. I like to help everyone. So if you did take value from that, please give us a like, subscribe to this channel, hit that notification so we keep you up to date with all the amazing content that we put out, and I'll catch you in the next video.